Well, our expert on the show today is Manish Bhandari. He is the CEO of Vellum Capital Advisors. He's been running the advisory services for a while. 2010, I believe, is when they started. And prior to that, of course, he's been in the capital markets for almost 2 decades now. Manish, thank you for joining in and welcome to the show. So first things first, as we just pointed out, I think a lot of investors, and especially newer investors, are fairly confused. They're wondering whether this is the start of a pretty long bull run or whether this is a high where they should start getting cautious and take some money off. What would you say?
The first thing is one need to understand that why this bull market has occurred. And there are 4 legs to this bull market. And when I mean bull market, we all are assuming the rise in the asset prices is reflection of the bull market. So the first leg of this is since 2020 March, which was one of the most severest month for all the asset prices across the globe. We have seen a steady decline in US dollar, which is represented by DXY index. And usually the DXY index follows a 7-year of uptrend and 7-year of decline or a downtrend. And this is something which is in history for last 40 years. And now we have seen the start of a decline of a US dollar versus the other major currencies. And usually in this kind of scenario, the emerging market does very well. And India became one of the beneficiary. And that's the reason you've seen this bulge of money which has come from the institutional investors. So what we have today in front of us is a 7-year of decline. That doesn't mean it'll go in one way. It will have some ups and downs, but at least from a structural point of view, we have a 7-year of decline ahead of us on the US dollar. And if I have to look at the history well enough. And the second thing is, which is very important for us to understand that why this bull market can continue for long, is also the second leg of this whole equation is about the fiscal conservatism, which way the government of India has handled the crisis of 2020 versus the way the crisis of 2008 was handled. So if you look at a study of parallel of 2 crises, the first crisis in 2008 crisis, we had a huge inflationary aftershocks, which from 2009 to 2014 produced a huge inflationary effect, and that changed the whole equation upside down and led to the huge decline in rupee versus US dollar. Versus in 2020, the way the fiscal situation has been managed from the monetary point of view as well as from the fiscal point of view indicates that we will not see a huge depreciation of rupee. In fact, I may err on going to say that we may see an appreciation of rupee going forward. And rupee has done relatively well versus other currency. So this adds to the reflexivity where the currency is not depreciating and doesn't look to like depreciating going further. So that attracts more round of investments. And the third leg in this whole equation is the stress by the government to rejuvenate the manufacturing sector of India. And this whole manufacturing story, which has been lagging for some time, ideally should put more legs to the revival of the earnings in the process. So if you add these 3 legs, which are mutually exclusive in some way or others, definitely gives you an idea that why we have seen such kind of revival in the Indian equity market, and equity has been one of the beneficiary. And the final leg is, if you add is the Atmanirbhar program of Government of India, which has got more legs to roll down over a period of time. And all these combinations ideally would is propelling the market and ideally would propel the market going forward. So that's where I think the combination is a long-term structural combination. We will see some ups and downs and volatility, but if you have to look at from a structural point of view, these 4 things are very solid pillars where this revival in the capital markets is sitting very strong enough.
All right, Manish, we have seen all-time highs before as well. November 2010 or November 2009, at that point of time as well, yes, we were at all-time highs. How different is it this time around? You're talking about a gush of liquidity. You're talking about lower interest rates as well. How different is it?
So difference is there is no, except the technology sector, which has led for some time between 2015-16 to 2020. Now you are seeing a huge sectoral rotation, which is from pharmaceuticals to cyclicals now, and going forward more cyclicals. So there is enough sectoral rotation and a wider participation which has started happening. And usually middle market companies or small cap companies, which is a reflection of a wider participation, is also indicating about the impending economic revival. and from one of the worst health and crisis, which is sitting on the intersection of health as well as financial and health. So from that perspective, you are seeing different sectors participating, and you are seeing a very wider participation. And also the structure of this revival is very different, because if you look at in 2014 and 15, we had some 20 million demat accounts, and today we have some 45 million demat accounts. So the number of people who are more inclined on the assets, looking at the financial investments and participating in the financial assets and the financial investments are far wider and far larger. And also the work from home has completely accelerated this investment process far more. And so in that context, we are going to see a very wider participation in this going forward as the momentum increases. So this is slightly different from what we have seen in the previous time, in my understanding.
So, you know, both the examples that you quoted, Manish, and I'm thinking about this, you referred back to 2008 and compared it to where we are today. And your answer made me feel that you find the present situation a lot more healthier because we haven't sort of done too much of fiscal excess, because perhaps currency depreciation is going to be lower. And then you also mentioned the increasing number of demat accounts. Now, in the past, the wisdom was that when retail is getting active, it's typically the end of the party. They usually come in when the party is about to get over. So has that traditional wisdom turned on its head? And now at this all-time high, what is the first thing that one should be doing? What would you advise our viewers today?
So the first thing is one has to leave aside this whole debate of all-time high, because there's no sacrosanctity of being all-time high, because I think the memories of 2020 March is so fresh in everyone's mind that we keep on looking at all-time high, and we have reached from X level or 70% increase from the bottom levels or so. So one has to look at the what are going to propel the earnings of the companies, and how economic situation is changing going forward, and that would definitely will give you an indication that where we are moving. So all-time high is no reason for celebration, or neither a reason for to be depressive by any chance.
Well, Manish, you know, this market either will make you a lot of money or will teach you a lesson that you'll never forget. Tell us the lessons from the previous bull run.
So lessons, a previous bull run. So let's look at what are the structures that changes in a bull run. So usually you will find the in the midst of a bull run, one, the holding company discounts, the companies with the holding company structures, and the discounts changes. And usually from a message of pessimism, you move to an optimism where the discounts converges significantly. And so one has to be very careful enough. And second thing is, just to give a flip to your previous point, that how do you look at it as a bull run, and how much steam is more left? I think very simple indicator for the investor is to look at the mid-cap indices to large cap indices ratio. And usually if you find that is a reasonably good indicator to predict are you in the midst of a bull run, are you in the peak of a bull run, or are you in a peak of a pessimism. You look at this indicator from 2003, from where the small cap and the BSE mid cap and the small cap indices are available, and they have been true enough to give you a prediction on the turning points. And usually the turning points were in 2007, and then it was in 2017, and also the peak of pessimism in 2019. So these ratios are able to give you a good idea, and today we are in somewhere mid of it, and we are not in any of the peak or either sides of the extremes in any case. So to answer you that the peak of indices is not a right representation of what is going to happen. You need to find a collection of companies. Ideally, we should do well. And now you did ask me about the mistakes an investor do. So I did said about the characteristic of a bull market where the discounting structures will change. There are 2 or 3 mistakes what usually people do land up in making in this whole process. First is I will call a seesaw ratio. A seesaw ratio is that people will sell their blue chips and try to buy from an FMCG company to fast-moving stocks. It's a fast-moving stock, so usually people do try to reshuffle their portfolio very significantly, and that may meet your temperament and they may not meet your temperament. And so you have to be careful about the sudden shifts you want to do in your portfolios. And usually what happens is people sell their blue chips, so blue chips will keep on going down by 1-2% or so, and you will see a hyperbolic or parabolic rallies in the small cap companies, which could be some of those rallies will be worth it and some may not be worth it. So one has to see those kind of indication and make sure that are you on the part of the which side of the table you are sitting at in this is. And second thing is I really found quite strange, and maybe in some way I also did mistake very previous in my life, is a relative value, which is I'll call a Felidae trade, which is like a cat and a lion from a same family, but they both have a very different structure, compositions and characteristics. So you can't do a relative trade where you are trying to sell X company, a market leader at a 30p multiple, and you're trying to do a catch up that another company will trade at a 20p multiple, and the discount will catch up. This is a characteristic of a bull market, and one has to be very careful in using these kind of trades. And the third thing is, which I feel I have observed, is reflexivity. And what happens is when the bull market and the economic data is good and the bull market is expanding, usually you'll find companies which will do well and which will propel their earnings. And as you propel those earnings for 5 quarters, 6 quarters, and 15 or 18 quarters or so, the P multiple also expands. So what you are buying at the end of the bull cycle, if you land up, you are buying an expanded P multiple and an expanded earning base earnings. And in that is a lethal combination, and which has happened with many companies in the previous cycle. So one has to be careful about in this reflexivity, and you have to observe these things very carefully before you want to make trades, and how would you want to preserve your capital in the process.
Okay, those are some really important points to keep in mind, and we've seen that in the past, right? That typically in a bull market, people take a top-down sector view, and then you're just trying to find cheap stocks within that sector. Manish making a very pertinent point that cheap might not always be the best or the brightest. Well, with that, we will take another very, very quick break. We'll come back, the conversation continues, and we will ask Manish about how to play the current bull market. Where do you begin? What do you look at? Mid caps, large caps? How is he looking at portfolios at the moment? The conversation continues.
Welcome back. You're watching Investment Guide here on CNBC TV 18, and we're in conversation with Manish Bhandari. Well, Manish, I wanted to ask you this question in terms of your big themes, the big investments you've made in the last few years. If you could give us a sense in terms of sectors, a sneak peek into some stocks as well. And also, what about asset allocation? Real estate, gold, and equities. How do you balance them out?
Nigel, there is no one science to balance it out. It all depends upon your individual preferences and your financial goals. My goals can be very different from your goals, and my ability to take risk can be very different from Surbhi's or yours. So there's no one answer that can you do a cut and paste of one third, because it sounds all three of them. So answer is no. And second thing is There are various, there is a sea of opportunities. Rather than telling you that this stock looks good and stock looks bad, out of a pool of maybe 1,000 companies which are maybe investable, meets up investable criteria, I would leave the audience with a fishing rod rather than the fishes. The fishing rod is look for companies which are gaining market share. They're hard to build moats. If you find companies which are gaining market share in their sectors, they may be leader, they may not be leader. So I'm qualifying this. So those companies are really worth investable, and if they're growing profitably, they're not compromising there. So that is one. They look at for companies which are doing innovations. So if you find there is some elements of innovation, because it's very difficult to put up that ecosystem of innovation, and if you find companies which are able to do the innovation, and then I would say that yes, hold on to those companies. You will see up and down maybe, but over a period of time, those companies will emerge winners, and the shareholders will attract a better quality of shareholders. So that is it. And finally, also look at there are new products and areas which is emerging, and you will find companies which are trying to address those new areas emerging out of maybe from a government reform point of view, from some structural changes in the economy point of view, and you will get enough time to make investment in those sectors and hold on to those companies over a period of time. So these are the set of opportunities. If you ask me where is a broader opportunity setting up, if you look at from history of the economic history of the various markets, then the privatization program has always given a good opportunity to in the world to participate for the investors and hold on to an asset from a long-term point of view. So privatization program in India also will give you a good opportunity to participate in companies which will change their natures and contracts as the ownership structure changes. So that is one area, and then there is various other pockets of opportunities here that are floating around in the process. You did ask me about the asset allocation, gold, real estate, and equities. So looking at what is the current economic architecture today in India, we have a real negative interest rate where the rate of inflation is higher than the rate of fixed deposits. So in that context, the possibility of equities in a medium term doing well is significantly higher, because people will rotate money from the other financial assets into the equities, and which you see now, which is happening now at this point of time. So that will be one area. And this will be followed by gold, because the same thing is happening on the global level. So gold will be a second thing. On the real estate side, you need to have a situation where this kind of situation where the negative real interest rate persists for long. And this was something scenario which happened between 2009 to 2014, and you saw a propelling of the real estate. So if this scenario persists for long, then the real estate will be last to move, because the first level will be the inventory clearing of inventory, and then you will see the increase in the real estate prices. So that will be my pecking order of the choices one could make in a medium term.
Okay, so equity, gold, and then real estate, looking at the way macros and interest rates, which are such a big factor, how they're shaping up. Got that, Manish?
Yeah.
So, now I'm going to come back to equity. So the other obviously interesting aspect about the market today is that everyone's now looking at mid-caps because they didn't participate for 3 years. So you tell us, I know you're not going to give stock names, but at least tell us what excites you right now in the market. And some of the clues are coming up on the screens. You've invested in a large gold finance company. You've been in a big rice exporter, a depository, a listed depository. So all the clues are there for our viewers on the screen. But tell us what excites you in mid-caps, and what are the most important filters you deploy while picking a mid-cap or a small cap?
So most of our portfolio companies does excite me, but I don't want to leave in a conundrum where we would be exiting something, and maybe the investors may find themselves in the process. So as an investor, we are invested in various opportunities. As a long-term theme, I can tell you two things which is going to make money. One is the government's Atmanirbhar program, which is very serious program, and government has shown a lot of commitment. So there are industries which are going to benefit out of this. Most of the industries will be industries where India has some kind of advantage in putting up the scales, the economies of scales together. Which includes ethanol blending program, as simple as this, an ethanol blending program. So that is one area. Second, I did mention to you about the privatization program. So the assets which are on the blocks on the privatization has historical value. And today what they are trading at is abysmally low value. If the shareholding has to change the value of those assets, I'm sure they are far higher than what they are quoting today. So, depending upon how the timelines go, but I think there is a value, deep value, which is sitting in these kind of assets. And the third thing which I believe for next year and a half will be the domestic cyclicals. And if you see what has happened, the huge rally in the global cyclicals has caught everyone by surprise. And why this is because the decline of US dollar usually is met by a corresponding change in the positive values in the cyclicals. So I see domestic cyclicals ideally would be a big investment theme. And also with the revival economy, this also propels with the domestic cyclical. So domestic cyclical is going to be an interesting theme for anyone to invest. And the leadership of technology is seeding. And finally, this technology leadership can finally move into leadership by the cyclicals in the medium term.
Well, Manish, you mentioned it a couple of times, but there's a debate going on between growth stocks and value stocks. What's your investing approach out there?
So in terms of our investment approach, we sit at an interesting juncture of growth at a reasonable price. There is a debate between value, there is a debate between growth. Your growth can be very different from my growth, and your value can be very different from my value. So there is no one specific definition. And I think 5 or 6 decades have passed since Graham and Dodd value was said to be the true value, and the rest other values are very different values. So we sit at Valum as a philosophy, we sit at an intersection of a growth at a reasonable price. So equities are there for a growth, and if you have a growth at a reasonable price, that is the one intersection which we usually do approach, and we are successful in doing that. And there are enough companies which will give you that, so at least you avoid the reflexivity which I spoke about, that you have a huge earning expansions and the PE expansions also happens, and then suddenly you have a cycle which changes and takes all of the gains. So a growth at a reasonable price value is an interesting approach for us to run money as an investors.
Okay, so growth at a reasonable price. The GARP mantra is what perhaps Manish and his team go by. Manish, it's been great talking to you. Thank you very much for sparing time and giving us some very interesting thoughts on the market at these levels. Well, that's a view coming in from Vellum Capital. And with that,